welcome back, everybody, to the 4-Star Podcast. I am Brian Kasal. I'm your host, along with my co-host, Mr. Christopher Reardon. Chris, welcome to the 4-Star Podcast again.
Thank you, Brian, and good afternoon to everyone out there.
All right, so let's talk. Boy, this has been a wild couple of weeks. Markets have closed up big after a very, very rough week with the Ukraine invasion and everything. So, Chris, where do we stand right now as far as the markets go? You know, the one thing that happened recently is commodities became number one, but where do we stand right now?
Yeah, so commodities is in the number one position, and from our last podcast, it's actually gained 16 points, and it now sits at 299. So about to break into that 300 range, which the last time, obviously domestic equities was in there, and I think international equities crept up there at one point, but it's been a very long time since commodities has gotten up in that range. So it's big there. Domestic equities in the number two position still held there, but it did lose 9 points from the last podcast, and it's at 275. So we are starting to see a little bit of a divergence there in the 1 and 2 position. We'll see if that trend continues. In number 3 position, international equities. This had the biggest drop. It dropped 21 points from the last podcast to 189 in the 3rd position. So really starting to see that number 3 position continue to fall. And if that trend does continue, we could see it drop to 4 and see fixed income start to move up into that 3rd position. So fixed income sitting in the 4th position, it's at 144. It gained 2 points from the last podcast. And then cash in 5th gained 6 points, and it's at 115. Currencies in the 6th position gained 7 points, and it's at 71. So really, besides commodities, the biggest gains really were from the more conservative positions. And I think that does reflect the increased volatility. We've seen, obviously, the last day and two, which you mentioned in the beginning, Brian, we've seen a little bit of a flip of that. But for the most part, the increased volatility and the trends have really skewed more towards gains coming from the conservative classes.
It's interesting, and that's reflected also by the fact that so many of the names that have brought the indexes down have been the big technology names and the large cap names that went parabolic in the 4th quarter, but the average investor, unless they had an outsized set of those positions, didn't do very well when most stocks got their gains in for the year by basically the summer, and it was only those tech names that took off. Well, those tech names have now turned down. So there's developed a whole new group of stocks out there, Chris, as we begin the year. Let's call it the 20% plunge club. That was a phrase quoted by Jack Howe with the Wall Street Journal report. So this past week, we saw Roku plunge by about 30%. We've since seen DraftKings, Shopify, Roblox, Spotify. Previously in this market pullback, we've seen Netflix, Teradyne, PayPal, Facebook, now Meta, and then a new name for Viacom, down 18% in a day. So we've seen a lot of names struggle, and they were just basically priced for perfection, actually overpriced, and then any sign of any trouble whatsoever, they plunge 20%. So that's a 20% plunge club. Investors are looking now for stability, and they're not sure what else they're looking for. Maybe they want a pat on the head or something like that, but they clearly don't want the high octane stocks anymore. No story stocks, just cash and stable things. So that's kind of what we've seen in the last 7 weeks, Chris.
Yeah, and I think it's important to note the last day or two, and this could just be an anomaly, and there could be unusual circumstances, and I don't want to make too big of a deal about just 2 days, but we've seen the last day or two almost an exact flip occur, where tech stocks kind of had a huge bounce back, and a lot of the stocks that you mentioned, the value, kind of lagged. So we almost saw a flip, and there are some, I've seen speculations in regards to that. We had kind of a little bit of a pop there. And if you have several people that are shorting maybe the tech stocks, or, some hedge funds that are making bets on the short side, because you can make large gains there, obviously, if the stocks depreciate. If you get a pop, it almost feeds into it because they have to cover their positions, in that case, go and purchase the stock as well. So we've seen that the last day or two, a little bit of a flip. But I think that points to the important conversation we've had on here, which volatility, although we correlate it usually with downside, also has an upside. So, I think that's really been a showcase of this market. We've had big down days and we've had some big up days. And it's just the volatility has certainly increased so far in 2022.
Well, and the biggest updates the markets will ever see on a particular update are usually in bear markets or downturns. And that today held that true. Now we're up 2.5% across the board on everything. And you don't see too many normal up days like that in a bull market. Usually the markets are down so much that there's a reaction, either short covering or people just exhausted, and then all the sellers are exhausted. And all of a sudden, boom, they come roaring back in for a number of reasons. And so, that holds true. So today, huge update. But boy, we've been in a wreckage of a market. We came into this week, Chris, with the S&P down 8%. At one point, the S&P was down as much as 13% during the week. The NASDAQ composite down 13 went to, well near to 20% by midweek, and it was in bear market territory. The Dow Jones was down 6%, Russell 1000, the Russell 2000, so small caps down 10%. So everything really getting slaughtered. The worst sectors were communication services, real estate, info technology, and consumer discretionary. But interestingly enough, the best sectors were energy, again, financials were flat, consumer staples were only down 1. So there were places you could invest in the first 7 weeks of this year and not get slaughtered. In fact, the dynamic portfolio that Forestar runs as we come into today was up 3%. We gained a little bit today. It did have a lot of commodities, obviously, which did very well, but it had stocks and it was up a wee bit today. But in a down market, when some stocks are down 20, 25%, anybody who was in those high octane tech stocks got completely slaughtered in this last 7 weeks. So.
Yep. Yeah. I mean, I think that's a good point. I think commodities, like we talked about in the beginning, have definitely been, I think, the name of the game so far in 2022.
And we've been saying that in the second half of last year, that, boy, be careful if you're playing those high octane tech stocks. We've all seen this before, and anyone who's around in 1999 remembers that. And sure enough, those stocks got slaughtered. So even though we have a rally today, they're still very heavily priced, multiple wise. And so, this decline may not be over. We've been in the portfolios that raise cash. We've been raising cash to protect value on the downside, and we're about halfway to a full cash position. If it gets any worse, we'll add some more cash and try to avoid loss. But right now, things are starting to move in areas where we never figured. We had earnings up 30% for companies so far in this earnings season, but yet the expectations are that the growth is going to slow to as little as 8% for the year. And so that could be another reason why the markets have been so rough. And then we've also seen for the first time in many, many years, gold has started to break out, Chris. So, Barrick Gold, Newmont Gold, all the mining companies, they're starting to finally break out. And people thought when Bitcoin came on the scene and really got fully invested in the last couple of years, and like we said in an earlier podcast, 55% of the Bitcoin owners now bought it in the last year. So a lot of people are new to it. Of course, now it's starting to plunge and people are moving into gold. So people used to say that Bitcoin is the new gold, but now it looks like gold is the new Bitcoin, or maybe gold is gold again. So gold's running as well. So Chris, what about the economy? You got a lot of economic numbers too, right?
Yeah, so we actually had some pretty positive numbers, and then I think some underlying numbers with the inflation that for the most part, I guess can be construed as negative. But retail sales, on the positive note, the retail sales rose coming into this year in January. They rose 3.8%. It's on a seasonally adjusted basis from January to December. So we started seeing spending again, very positive from that, especially as we saw that slow down a little bit towards the end of 2021. Consumer spending on that note rose a seasonally adjusted 2.1% in January from December, which was a very nice rebound from the revised down 0.8% we had in December. So we saw kind of a nice rebound back to start this year from consumer spending standpoint. Then on the inflation front, the personal consumption expenditures index, which excludes energy and food, which tend to be the volatile categories, that rose 5.2% in January year over year. So we're starting to see that spike up a little more. And that was the sharpest 12-month increase for that kind of index since April 1983. So obviously a higher number running there. The producer's price index, which measures kind of the goods, the raw goods that the producers that kind of go into the goods we purchase, that rose a seasonally adjusted 1% in January from December, so it continued to increase. Most of that, I think, was due to some of this disruptions of the Omicron surge. The 12-month basis, it rose 9.7% on a 12-month basis, so year over year. So that continues to accelerate, and obviously 9.7% is a very high number, something that I'm sure the Federal Reserve is keeping a close eye on. And then to mark off, historic 2021 on the home sale side, the S&P CoreLogic Case-Shiller National Home Price Index, so kind of the average price of a home across America, rose 18.8% in 2021. And that was the highest calendar year increase since the index began in 1987. And it drove the median existing home price to $350,300. So we continue to see that rise. I would say existing home sales to start the year this year in January were up 6.7%. It was kind of a spike. We did see some slowing towards the tail end of 2021 we talked about on here. Most of that was expected because with the Federal Reserve rate hikes expected, we saw a lot of home buyers rush out there, try to take advantage of the low interest rates while they could. So usually we see that spike. We could see that obviously taper off, especially as the expectation would be as the Fed does raise interest rates, that starts to kind of temper that down a little bit.
Mm-hmm. Yeah, no, Chris, you mentioned the thing about inflation, and we've been talking about inflation here in the podcast for quite a while. All the numbers you said, are recovery numbers, and that's good, but yet that inflation number really could hamstring the economy. The Fed came into this week ready to have an emergency meeting, but we didn't hear anything out of that meeting. And we're going to have a meeting on March 17th, and that might not really give us the clarity that we need. There's a pretty wide consensus that at least a quarter of a point of interest rate in the short run on the Fed funds rate will be added, and maybe 50 basis points. And so the Federal Reserve is, we think, wishing that they had started to do this last fall, because we got all the negatives of a rate increase where the markets tend to react negatively without actually having the rate increase. So now with the S&P down, let's say 10% roughly, and then the tech stocks in some cases down 20 and 25%. So all that's obviously negative, reaction, and we didn't even get a rate increase. So it's kind of a frustrating time. That also tells us that the Federal Reserve is probably, in a difficult position to say they're going to raise rates a lot, because if the economy is getting a little bit better, but yet markets are reacting to this way and growth is expected to slow, it's going to be hard to see the Fed raise rates so dramatically, Chris. In fact, at one point, Jamie Dimon said 7 rate increases. The consensus was 4. Our 4-star economist, Bob Barone, says maybe 1 or 2 rate increases is all they could get away with. So it'll be very interesting to see how this plays out. We've never had a pandemic economy where we went into a pandemic in the modern financial markets. Last time was 1918, and we didn't really have a big stock market back then at all. And then we've never had a pandemic recovery either. So we're not sure how this is going to work. Chris, you have some good inputs, right? Then you have some bad inputs, and it's like your head's spinning. It's hard to make sense of the whole thing. And so the market reacts whatever it seems to.
Yeah, I would say for sure with obviously the geopolitical tensions going on between Russia and Ukraine, or you could even call it obviously the war going on right now between Russia and Ukraine, the Fed would certainly want to be ahead of that. I think some of the recent pop if you will, we've had in the market has been the assumption that the Federal Reserve, instead of that 5-6 number that was floated, rate increases that was floated, it will be more tepid at the most 2 now. I think, or at the most 4 I've seen now. So as those consensus come down, you're going to have some pressure taken off the market, at least with the expectation. But I think it's important, like you said, Brian, that we don't know what they're going to do, and this is still, they're in a tough situation. They're in between a rock and a hard place, really, because inflation's only going to increase with these commodities, specifically oil. So they have to really raise rates, but with all the tensions and everything going on, how much will the market take? It'll be really interesting to see, and it's gonna create a ton of volatility. I mean, we're going to be essentially eyeing the Fed to see what they do, and if they overstep, if they do a 50 basis point, we could see a major pullback.
Yeah, we could. And then now there's all kinds of talk about inflation again, and what inflation is doing to us, and obviously we're losing purchasing power. So some of the old timers, I count myself among one of them, talk in terms of the way it was in the 70s and the early 80s, when last time inflation was 7.5% was 1982. And I remember going into a savings and loan. Of course, we all know what happened to the savings loan industry. It all went bust and had to get bailed out by Federal Resolution Trust Corp. But we had a 20% money market at a local savings and loan in the suburbs of Chicago, and interest rates were very, very high. So back then, when you had 7% inflation, we also had high interest rates. So we were still gaining something on our money. We were gaining more than the inflation rate. Now interest rates are near rock bottom and we're losing ground. So some people have been saying, well, this is actually worse than the 70s because we're losing ground. And in that sense, that's exactly right. Yep. We're losing 5 to 7% how much that we get on our fixed income or cash management. So, it's time actually to see maybe rates go up a little bit. And, we think inflation will moderate. The general consensus is by year end, inflation will be back down to kind of a normalized like 3% level. But, right now it's certainly rough, Chris. You see, gas prices up 40, 50%. Used cars are up 30, 40%. It's crazy. And used cars aren't very nice even, new cars are nicer than used, but there are no new cars around. Instead of having 300 cars on the lot, you go there and they have 20 cars. So what are you going to pick from?
Yeah. So. And it's going to be interesting. It's going to put pressure on the economy for sure. I mean, everyone's been hearing about wages going up, but on average, wages are going up 3, maybe 4%. If inflation's, clipping at 7%, the net purchasing power of those individuals is still going down. They're still losing. They essentially lost 3% in wages, really, if you can imagine that. So if it sticks around up here, the longer it hangs here, we could see spending start to decrease a little bit. We could see certain implications happen. So that's why the Fed definitely wants to get it under control. And I think if it does get down to that 3-4%, I think the Fed will kind of consider that a victory, if you will.
Yeah. Well, and then there's always risk of a global recession if the economy continues to, throw some negative inputs in there and the economy slows down again, and maybe they raise rates too quickly and then things slow down. So there's always a chance. Then the question always is, after all these discussions we've had about markets and the economy, is what does the market react to? Because there's pretty well researched pieces that say that even though the economy was very rough in the pandemic year, when we basically shut down 40% of our economy in America, we still had, after an initial plunge, the markets recover, the stock markets went up. So there's so much cash out there. They've issued $6 trillion worth of cash to the public in some form, plus all the lending at the banks, that maybe the markets were reacting just to the flow of funds and the cash out there. So there's always the question of what is the economy doing, and then how do the markets react to it? Sometimes economy inputs are negative and the market still goes up, and sometimes it's positive and the market goes down, anticipating something else. So I guess we always have to watch, Chris, what the market's doing, we don't buy economic numbers, we don't buy wage growth numbers, we don't buy all these other numbers. What we actually buy are investments, shares of stock and bonds and real estate and other things. So that's what we really have to watch. And so that's what we spend most of our time on. So Chris, now you mentioned about how inflation is affecting India as well.
Yep. So we're starting to see inflation. One of the highlights was India's economy start to kind of rear its head there. The India's inflation accelerated to 6% in January, which is well above where they usually are, which is about 3.6%. That's kind of their pre-pandemic average. So we're starting to see that impact kind of the East Asia markets as well. We've heard about it here and there in China, but it's not only in China, it's in, once again, India, you have it in Vietnam, you have it in other countries there too. So it's not just a US and European problem, it's really a global problem. And most likely with the geopolitical tensions, it's in the short term going to get worse. We've seen a lot of central banks around the world try to get ahead of it. Some have, already started raising rates. To your point, Brian, in the fall, so they kind of got ahead of it a little bit before the U.S. did. But I think everyone's kind of trying to race to get it under control.
Yes. Well, it is affecting the rest of the world. Interestingly enough, Chris, one of the mini trends that we've identified is, with all the craziness going on in Canada, with the Prime Minister basically attacking the protesters who don't want mandates and masks and everything else. There's been a rush to crypto because many of the people who were involved in that rally in Ottawa have had their bank accounts taken away and their money taken away from a tyrannical, what's turned out to be a tyrannical government in Canada. And so now we're seeing some people rush to cryptocurrencies. So the whole idea behind cryptos is that you are outside the government currency. Your assets are not tied to any one government, no matter what they do. And most of the time, it's because they're issuing too much money and creating inflation and but no one figured that it would be because governments are confiscating my assets and my bank accounts, which is what's been happening in the last week or so up in Canada. So we're seeing a little mini trend to go back to cryptos for the real reasons people originally bought cryptocurrencies, which is to protect against governments in a different way. So,
yep,
what do you think of that?
I think that it's sad that they have to go that route because obviously, as we've talked about on here, I mean, cryptocurrencies are extremely volatile, so it's a risk. I mean, you could gain a lot from it. You could also lose half of your, savings or income. But the other thing I think it's heightened, I would say, in this time is, as we talk, the war going on right now between Ukraine and Russia, the potentials, I think we've seen more cyber warfare and disruptions from that front and the fear of cyber attacks. And I think that's one of the drawbacks. And I think that's one of the things, like you talked about in the very beginning, Brian, why gold has actually kind of come back a little bit because, gold is in itself obviously a physical asset. And, if the Russians hack, the major databases here or anything happens, accelerates, you still have the physical asset of gold. Whereas cryptocurrencies are very much virtual and can be hacked. You can be kind of locked off from them. There's a lot of implications from that front. So, there is drawbacks to it, but I do think, obviously, and I think a lot of people, believe, I think the Canadian Prime Minister overstepped his bounds. I think some of the precedents he set are very dangerous and, could come back, are going to, I believe, come back to haunt him in many ways. But at least I think as last I heard, they have kind of released that power that they invoked at the time. So they don't have that anymore. But, it's definitely a lot going on and a lot of friction, if you will.
Americans sometimes forget all the protections that our founding fathers built into our Constitution and then the Bill of Rights and those kinds of things, that those things can't and shouldn't and can't happen in America. Let's hope it stays that way. One other really interesting thing that has been unearthed in the last few weeks, Chris, is about the pandemic. many of our politicians have been using, as Rahm Emanuel once famously said, never let a crisis go to waste. So as people are scared and wearing masks and enforcing vaccine mandates and things like that, then very often deaths were not being reported properly because it was politically expedient to report them certain ways. In fact, the governor of New York State ended up having to resign based on certain things that he had done, and the word had come out obviously that he had faked some numbers as well about deaths in nursing homes. The life insurance companies, however, are coming out with numbers for deaths of ages 18 to 64 are up 40% from the pre-COVID era. And it might be from now, they think, from vaccines, but the press is not reporting it. So many more people are dying than expected, some from COVID, but also from the vaccines. So whether our politicians have been telling us the truth or not, the life insurance companies have an obligation to report the truth because they then have to pay out those policies. So now we're starting to see some of the real numbers come through, and they're not good. Life expectancy in America went down in the last year and a half because so many people passed away earlier before their time. So that's really obviously a sad development. So let's hope now that the vaccine mandates are over and the pandemic seems to be pretty much over. It seemed like everybody I know got Omicron for like a day, and then it went away. And so now, all the infections were up big time, but it was a very mild infection, maybe a cold, and then it went away just as quickly as it came. So anyway, we'll see, Chris. And, it's good that finally things are opening up.
Yeah, I mean, I think the positive thing is I think most people have come to the realization, some took longer than others, some states in particular, that this is endemic and we just have to find a way to live with it, mitigate it as much as possible. And I think, providing for people that want to take vaccines and go that route, provide it. And, we do the same thing with the flu. I know, actually, we were at a doctor's appointment yesterday, and they said that the flu at this point is much more serious and deadly, right, than COVID, much more of a risk. So, I think it took a long time to get here to the final iteration. We hope, I should knock on wood, but I think at this point, hopefully it'll just be more treated kind of as a flu going forward, and as it should be, because I think it's here to stay.
Hey, Chris, did you hear about the new variant? It only affects politicians who want to get reelected. So they're quickly lifting their mask and vax mandates, long after they probably needed to. So anyway, hey, Chris, on the positive side, movies are back. And the lead times for online streaming are getting longer and longer. So people want to be in movie theaters and experience a movie again. That's exciting. So that's good. That's good news. The economy is coming back. People are coming back. And then also the media did very, very well with Netflix, and so did Disney. All the different media that's out there doing extremely well as people are getting more social again and getting involved in movies. So that's pretty exciting stuff.
Yeah, I think it was Cinemark or AMC posted their first positive quarterly earnings in, I want to say, 8 quarters. In the fourth quarter. So they are starting to come back. I think there is a return to normalcy people want. They want to go out, go on a date night, go to the movies, and I think the missing ingredient, which will come back this year, is good movies to go see.
Yeah. Well, and every year around this time, the list of concerts in our city and other cities comes out, and all the different concert venues, from the outdoor ones to the indoor ones, and the seasonal ones. And so this year's concert list is longer than ever. And so again, Chris said, it does feel like the world's coming back to normal. And for all you bettors out there, the Super Bowl's over, and the NFC won, the LA Rams. So back in the old days, we used to say if the NFC won, that meant the stock market was going to go up. And if the AFC won, that meant the stock market would go down. I'm not sure that's true anymore, Chris, but nonetheless, those of you who remember that one, you can bet on the stock market going up now because the LA Rams beat the Cincinnati Bengals. So what else you got out there, Chris? Anything for our investing public today?
I'm just trying to think of the past Super Bowl champions and reaction in the market. So I guess the Tampa Bay Bucks were NFC one last year, and the market did go up. So maybe there is some validity to that.
It was that way in the 90s, that's for sure. Some of that stuff has changed. Well, great. Well, we just want to give everybody an update. We'll be back with some great interviews on today's Market Explained podcast. Thanks everybody for joining us today on the 4-Star Podcast, and we'll be back with another episode of really interesting things to say. Thanks again for being with us.